This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi, Diana.
Hi, me.
Have you checked your super balance recently?
I haven't. Why? Should I?
If you do, you probably would see your super balance going down quite a bit over the past few weeks.
I've had a few questions on this lately. So what's been going on in markets?
So US share markets have fallen for a few consecutive weeks now, and it's now down about 10% peak to trough. Australian shares down about a similar amount, roughly 10%. If you are invested in European shares, though, you would see a bit more of a positive outcome there, but it's still down roughly 3-4% over the last month or so. So not a very good outcome if you're mainly invested in shares over the past few weeks.
So I suppose the reason that markets have been a bit downtrodden in the last few weeks is basically concern that the new policy announcements from the US administration, mainly around tariffs and some of the changes that the DOGE Department of Government regulation is doing, is going to be negative in terms of growth for the US economy. And of course, the uncertainty that has for global trade and global growth. And I think also some of the on and off war ceasefire announcements are not helping markets either. So let's go through some of the US data that we've had. I think the main thing that spooked markets was that Atlanta Fed GDP Now indicator.
It's showing a recession, in the US.
So what is this indicator? Should we pay attention to it?
So the Atlanta Fed GDP Now is basically a model using all of the available economic data that we see throughout the quarter. They put that into the model to see where we're growing at. And now it's showing a negative 1.8% seasonally adjusted annualized rate of the March quarter. That's quite massive compared to the 2% growth that we've seen over the past few quarters in the US. So when you look at that numbers, it looks like we're heading into a recession.
It does, but I don't think we should get too spooked just looking at that, because if you look at the components of it, there was a big increase in imports over the past few months. I think some of that has to do with people pre-purchasing goods ahead of potential tariff uncertainty. And then also there was a strange increase in gold imports, which doesn't get included in the GDP data. So I think that the GDP now is overstating the weakness in the US economy a bit. Plus, we always get a few weird seasonal things going on in the March quarter in the US because of some of the weather that can't be seasonally adjusted away by the statistics agencies. So don't get too concerned about this one number. I mean, some of the other indicators out of the US that I think look more worrying is the inflation expectations indicators for consumers.
Yeah, and it actually reached to the higher level compared to where it was in 2022. So back then we had so many upside pressures in inflation with the war going on, with a lot of supply shortages, but it actually didn't change people's perception of long-term inflation as much as now, with constant tariff news and threats of more tariffs and trade wars going around the world. So I feel like this time around, it seems like a more credible threats for the Fed to worry about people's expectations, because that would probably feed into actual spending habits. People might put back purchases a little bit more that actually would eventually feed into the GDP data numbers. And if you look at sentiment numbers, for example, both consumer and businesses' sentiments are now actually pointing downward compared to before. That's quite worrying. It basically erased all the gains that it had since the election of Donald Trump. So again, that probably would force businesses to delay all of their CapEx plans or investments. And again, that would feed through lower GDP numbers throughout this year as well.
But in terms of the Fed, I think it's still likely we will get another 1 or 2 rate cuts this year, but maybe not so much in the near term. I guess the inflation data has sort of been a bit mixed. Some numbers suggest a further slowing in things like shelter prices, which is good news for core inflation. But the inflation data is hardly giving the Fed the green light that it needs to cut rates even more aggressively than it already has, right?
Yeah, and I think that's what worrying markets at the moment as well. At the beginning of this year, before Donald Trump took office, I think markets were pricing in something like 3 to 4 cuts even for this cycle. But now that has been delayed. The Fed is probably really dependent on whatever data is coming out over the next few months. And that uncertainty is really spooking markets at the moment. And I think in our views, markets probably still have a bit more to go
Yeah.
we probably will see another 5 to 10% decline over the next few months, especially if the tariff man keeps on announcing new tariffs every day like this. And to go back to that tariff news, so steel and aluminum tariffs are now on. Tariffs on Chinese imports are now actually over 30% at the moment into the US. Basically, it's going to feed into actual data and consumer spending over the next few months. So we probably will just have to wait and see at the moment, just like the Fed now.
So it seems like the 2nd of April is sort of the live go date on more of these tariff announcements. We've already had news around China, Canada, Mexico with some exemptions, steel and aluminium, some more threats on the European Union. But on the 2nd of April, I think Trump and his team are going to come out with another bang announcements around tariffs. So I think that's going to set off some more downside for financial markets from here, and especially for US equities. And it does look like the average US tariff rate is going to rise to its highest level in a few decades. So I think there are a few offsets here, though. Some of the tariffs are definitely going to be used as negotiation tools between the US and other countries, particularly Canada and Mexico, because we know that Trump and his team want to see some changes around the border controls, drug flows, and then, of course, some of the intellectual property concerns that they have with China. Even for Australia, they're saying that we dump some of our cheap aluminium onto their market. So maybe they want to negotiate some specifics with even Australia as well. There are policies from the Trump administration that actually may have a positive impact on the US economy over the longer term and on markets. For example, they're still talking about passing the bill to extend personal tax cuts. They're still talking about cutting the corporate tax rate. Maybe the tariffs will revitalize some part of US manufacturing, although that will probably take a bit longer to flow through into the actual economy and markets than just in the short term. And markets do tend to be short term looking. But then we may get a deregulation push from the Trump administration as well. So in the short term, I agree there is more downside to US share markets in particular, and I think Australia is going to follow through on that. But in a year's time, I still think that share markets can have positive performance. I think the risk of a US recession is low, and if we do get a technical recession, I don't think it's going to be too deep because the labour market still looks like it's holding up pretty well.
Speaking of recession, I remember last year in August, we had a bit of market pullbacks as well. Massive declines in the first week of August, and that was actually stemming from the fact that US unemployment rate reached the SAM rule threshold.
Yeah.
So just a bit of a recap, the SAM rule basically says that if the unemployment rate reaches 0.5 percentage point above its trough, above its 3-month average trough over the last year, then the US would probably have a recession. And it did hit that target. We still have not had a recession so far. And right now, unemployment rate in the US is still at 4.1%.
Yeah.
Even with some of the DOGE cutbacks in federal workforce starting to happen already, we still haven't seen that flow through to the larger workforce impact yet. So I think the unemployment rate at 4.1% at a 25-year low is actually a pretty positive outcome for the US, and that's probably still supporting consumer spending so far. And we do see that in the retail sales data coming out of the US this week as well.
So moving to Australia, we haven't really had much news lately, apart from the fact that we are also going to get stuck with higher tariffs on our steel and aluminium exports. But again, just to remind our listeners that is about only $1 billion of total exports that Australia has made to the US in the last 12 months. We export about 4.5% of our goods to the US. So as a share of GDP, we are talking very small numbers. Of course, for those particular producers, it's going to have a significant impact. And some, like BlueScope, are even talking about moving production facilities directly into the US. But it's not going to start a downturn here in Australia or anything like that. And I actually think that some of the data has been looking a bit better in Australia lately.
Yeah, I think locally, data flow has definitely been a lot stronger compared to the US. We've started to see consumer sentiment feeling quite a lot more positive over the last few months. People are now feeling quite ready to purchase major household items. Housing sentiment has turned up. So we've seen a bit of a housing slowdown in Australia over the last few months with negative national house price growth. But it's turned positive now. And even with cities like Melbourne and Hobart that has been long in declines, it's also starting to see slower decline momentum as well. If you look at things like building approvals, that's a very early indicator for how the construction industry is feeling about the prospect of new construction in Australia. That's turning up as well. It's quite positive. We are starting to see a lot of unit approvals in the mix as well, consisting of about 40% of new dwelling approvals.
Yep.
At its low, unit approvals were only accounting for basically 1/3 of approvals in Australia. So that's actually a really positive sign for what's coming up over the next year as well. And moving back to even business sentiment, so businesses, even with all these tariff and global trade war threats, they are starting to feel slightly more positive compared to before as well. And I think this is definitely a flow-on effect from all the positives that are happening in the consumer sector. So not bad at all. And I think even with tariffs, no doubt in the next few months, we're going to continue to see headlines about new industries getting targeted. This is nothing personal against Australia. The US is doing this against all of the other countries around the world as well. Yes, we're probably going to see some impacts with some meat farmers, particularly beef and lamb. We export a lot of that to the US. Some pharmaceutical products will definitely be targeted as well. Because a large part of our pharmaceuticals manufacturing here was actually for the US companies as well. So for those companies, it's probably now time to diversify their customer base a little bit. But for the vast majority of Australians in 2025, you shouldn't really worry about these things because it's a very, very small part of our economy, which is already starting to see many, many positive signs.
So our Prime Minister Albanese said that we are not going to retaliate the US tariffs that have been put in place for steel and aluminium, but instead buy Australian-made goods. He even called out to buy Bundaberg. So I think that there's going to be more of this push coming through the Labor government in the lead up to the election, in particular ahead of the budget, which we get soon. The budget numbers are going to look a bit better for this current financial year. We're still going to be in deficit, but a smaller deficit than predicted in the mid-year economic and fiscal outlook in December, and then a better outlook for next year as well. But I think the out years are still going to show pretty large deficits because we still have these big spending pressures on our economy through the NDIS, aged care, healthcare, and of course interest expense. So I don't see any major changes from the budget that are really going to address these long-term structural budget problems. That's an issue, I think, for productivity growth in the long term. But from the budget, I think we're going to get some election sweeteners.
Yeah, totally. I think we're definitely going to see some extension of the energy bill reliefs that we've been benefiting from over the past 2 years. So the reason why the government is definitely going to extend this is because if they don't, then we'll see a massive spike in electricity prices for households from the 1st of July. And that's probably not something that they would want to see, given that headline inflation has been smack bang in the middle of the target band for a few months now. And that's a pretty good outcome for most Australian households. That's probably contributing to the fact that we are all feeling a little bit more positive now. And last year, the government introduced this Future Made in Australia program targeting spiking up manufacturing within Australia. And I think there will be a bit more of a push for that direction throughout this year as well. I'm not sure if all of these announcements have had a positive impact on households, but we actually do see a bit of a swing in the polls towards the Labor government in the past few weeks.
Yeah.
We all know
Still
that
very tight though.
they're still very tight, still quite around neutral. The Labor government has been lagging behind the coalition throughout this cycle so far since the beginning of the year. I think the most likely outcome for Australia is probably still a hung parliament.
That's probably the worst outcome as well because that's hard to pass policies in that environment.
But that would also push most of the policy agenda to be quite a lot more centered. And that's probably a positive for financial markets throughout history. If you see most of Australian elections haven't had a massive impact on financial markets in Australia. And that's also probably because we're pretty centered and sensible in most of the economic policies.
Well, that's it for this week. Thanks, me. See you next time.
Thanks, Diana.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.